Good morning and welcome back to the Camarda Wealth Channel. I'm your host, Troy Lerche, bringing you this week in wealth. Wanted to give you a little bit of market updates for the week ending October 22nd, 2021. We're not going to have any special segment or cover any topics this week. I'm going to kind of just go through what last week brought, which was an uptrend in the markets and something we're seeing our portfolios perform really nicely. So with that, we'll jump right in. We have the CAPE indicator rose even more, 38.70, up from the prior week's 38.08. We also have we remain in cyclical bull territory, and 4 of the 4 indicators are positive still. So right now, things are still green, and we're, like I've mentioned over and over, we're on high alert, but the market's performing nicely in October, and we're keeping our clients invested. Last week, we had in the U.S., most of the major indexes were up for the week by positive earnings. The Dow rose 382 points. Technology heavy NASDAQ crossed the 15,000 level with a 193-point gain, which was up 1.3%. And then by market cap, we had large caps up 1.6, mid caps up 1.8, and small caps up 1.1. International markets were mixed for the week, and we had the Morgan Stanley, or as grouped by Morgan Stanley Capital International, we have international developed markets were up 0.7%, and emerging markets were up just 0.2%. Precious metals for the week were solidly to the upside. Gold rose 1.6%, silver surged 4.7%, and energy continued higher for the 9th consecutive week, another 2.5% to 83.76 per barrel, which I know many of you are feeling at the gas pumps. I know gas prices have risen quite a bit. And then the industrial metal copper, which was up over 10% last week, retraced most of those gains and dropped 4.9% last week. Next was sales of existing homes rose in September as the threat of rising mortgage rates compelled buyers to lock in deals before the opportunity passed. And then at the end of the month, there was just 2.4 months of supply of existing homes available, and analysts consider a 6-month supply balanced housing market. So that's a big. It's maybe sounds like very close to the 6-month mark, but I think there's a lot of room in between there that truly shows the supply shortage of the homes. There's a lot of good information here about home construction and more data. This one's about the U.S. economy is still growing at a solid pace, according to the Fed Beige Book, which pretty much it noted near universal reports of lack of workers and inability for companies to obtain needed parts and supplies. Again, supply chain disruptions and lack of workforce is becoming very repetitive, and it'll tie into our final point, I think, which is the right here with inflation in the U.S. now more than double what the Federal Reserve wants, stated target of 2%. Economists have been at odds whether it's transitory or beginning of a new monetary trend, with the vast majority of developed worlds instituting economic lockdowns and massive government stimulus to combat the COVID-19 pandemic. It makes sense that would fuel inflation in modernized countries with just-in-time supply chains, negligible spare capacity, and then the sudden injections of massive stimulation from governments. However, Sweden bucked the trend. The country did not mandate shutdowns or lockdowns, consequently saw no need to overstimulate the Swedish economy since everyone was still working. And now Sweden's services inflation is about 3% less than the U.S.'s, and within the normal, quote unquote, normal range. So the $64,000 question, will the U.S. follow suit, see its inflation decline, or a massive current and proposed stimulus generate unmet demand and consequent inflation? So if you see the chart here, we can see the dotted line is the U.S., and then we see the solid line is Sweden. And this just goes to show you the complete opposite direction that they've they've been realizing by not instituting mandates. And so we'll see how this plays out. Until next week, I hope you guys have a great week. Stay safe, and we'll talk to you soon. Take care.